Hi, today I want to talk a little bit about what we're seeing going on in the market. We've seen over the last several months a little bit of an uptick in inventory. That uptick has actually been very good for the market in so much that we are seeing it kind of balance out in a lot of areas. In other words, it's not a seller's market, it's not a buyer's market, it's what we refer to as balanced. And balanced is really probably the best place to be because then you're getting a little bit of negotiations on both sides. Sellers are giving up a little bit, buyers are giving up a little bit. It's more of a win-win situation. And one of the primary things we're seeing with this more balanced market is buyers getting what's called seller concessions. Now, I've talked about seller concessions in the past, but basically what it is the seller is agreeing to pay some or all of the buyer's closing costs so that they can purchase the home. It's an incentive to purchase the home. Today, however, I want to specifically talk about taking some of those concessions and then using it to either permanently buy down the interest rate or temporarily buy down the interest rate. Now, I've also talked about this in the past where there are those two different kinds. There's permanent buy downs and temporary buy downs. Examples of temporary buy downs are like a 3-2-1, a 2-1, a 1-0. Those are all terms that we utilize. To put it in a more layman's term, let me specifically give you an example on a 2-1 buy down, 2-1 temporary buy down. So let's say for the sake of this example, the interest rate, the note rate is 7%. We're going to temporarily buy down the rate 2% the first year. So we're going to take it from 7 down to 5%. And you'll be at 5% for the first 12 months. Then it'll adjust only 1% from the note rate to a 6% rate and remain that for months 13 through 24. Then in the beginning of the third year through the 30th year, you're going to be at that note rate of 7%. Now, a permanent buy down is also just as it sounds, where you're permanently buying down the rate, you're taking it down to a certain rate, and that's it. It's never going to adjust from there. You're just prepaying some points, prepaying some costs to get down to a lower note rate. So I have a client that we're working with. They're in the middle of negotiations, and we're talking about potentially doing a 2-1 buy down, where essentially it's going to save them about $400 a month the first 12 months. And then in the second 12 months, it'll save them about $200 a month before it eventually adjusts up to the note rate and gives them their more permanent payment for the life of the loan, or remaining life of the loan, I should say. And if they were to then also take that same money from the seller and then use it and just do a permanent buy down, it would save them about $130 off of what the note rate would be on the temporary buy down. Okay, so you're sitting there saying, okay, well, which one's better? Well, that's the beauty of it. It depends on your circumstances. The temporary buy down might work if you are, let's just say as an example, you're beginning your career, you're kind of at the early stages, and you know over the next several years that you're going to be getting some raises, making more money. And so you want to kind of grow into your payment. This is a way to do that, because you qualify at the 7%, but being comfortable is a whole different conversation. And just because you qualify doesn't mean you're comfortable with the payment. So this temporary buy down might be a great way for you to go. However, a permanent buy down might also be good for you if you're not necessarily at the beginning stages, you're not necessarily going to be seeing any significant raises over the next several years. In fact, they're going to be relatively modest in nature, and so you just want to get that payment and that rate as low as you can, just kind of lock it in and forget about it. So that might be a better way for you to go in that example. But that's just it. It depends on what your circumstances are, what's best for you. And that's where we come in. We have the consultation with you and figure out what's the best way for you, which one makes more sense. Because it's not what I want, it's what you want and what you need. So listen, I hope you found this information helpful. if you have more questions around temporary buydowns, permanent buydowns, just the loan process in general, please reach out, give us a call, text us, email us. We're always here to answer your questions. Always looking forward to assisting you. You have a great day. We'll talk to you soon. Bye-bye.